What's going on, everyone, and welcome on into the video. Today we're talking the gap trading strategy, and we're going to outline how the strategy works. Very straightforward, very simple, to the point. Let's cover it, let's dive into it, and then hopefully you can take this strategy and start applying it to different stocks. And I'll give you a couple stocks that this actually tends to work really well on, and it may not be what you think. So changing it up a little bit from some of the tutorial videos that we did about platforms, how to do this and how to do that inside of your trading account, but let's talk about some actual trading strategies here that are very useful. And we have a perfect example to dive into right now with ticker symbol SPY. This is the S&P 500 ETF, okay? So the gap strategy, guys, we need a gap up or a gap down. Now, what is a gap up or a gap down? Well, you can look at it a couple different ways, and there's gaps on all different time frames, and gaps could be because of offerings, could be because of news, could be because of overnight movements in the overall markets in a stock, after earnings, after anything that kind of happens that can really move a stock in either direction overnight or during any time period. However, they're most commonly created overnight, okay? So if we're looking at the chart right now for the S&P 500, at least when we're filming this video, right? We see all these candlesticks, and we have some videos if you want to go back and learn hollow candles versus Heikin-Ashi versus all different styles of candles. Check out those videos and the playlist here on the channel. It's a great resource to go back and refer to if you're confused about what some of this stuff means. But the hollow versus the solid doesn't matter too much. What we're concerned about is like spots like this, where there's like kind of a gap where we close and then we open higher or open lower from the prior day, right? Or the prior candle. In this case, each of these candles is 1 day because I'm on the 1 year, 1 day chart. And I know I tend to talk fast, so I'm going to try to slow things down so we can kind of understand things. But we're looking for a gap overnight, okay? Now, referring back to that example that we literally just showed, I can just draw this gap in right here, okay? So I'm going to draw this gap in pretty much from where we traded up to the high on this red candle right here on the 14th, and then the low that we saw on the 15th, okay? So there was no trading volume or there was no price action in between those levels after that gap up, right? So what we look for is a move back to the downside below the low of that candle, below that bottom wick, which we ended up getting 2 days later, which then filled this gap and some back to the downside. So these gaps tend to get filled. They don't have to get filled. It's a very common misconception, and I don't want to bring or at least run you down that path of, oh my gosh, these gaps, they got to get filled. This trade has to work. It has to go and fill the gap completely. There are plenty of examples where stocks enter the gap and then get rejected or they bounce or whatever, and they don't actually end up filling that entire gap. But it could be a very high probability trade if you let the trade work out, or at least you have a tight stop loss or you have your risk parameter set and you're not hoping and praying. Obviously, you enter the trade, you define where you're going to get out if things don't go your way. However, based on this strategy and the gap, you have a lot of factors that could be playing to your advantage. So let's talk about this example actually from a couple of days ago. It is like one of the best examples I have seen in quite some time, and it worked out extremely well. So I'm going to go to the 30-minute chart because it is a couple days back. So each of these candlesticks are now 30 minutes. So take a look at this. We had a massive move up on a Friday, right? We go into the weekend. There's a lot of turmoil right now, Russia and the Ukraine, at least when we're filming this video. So we ended up gapping down across the overall markets. Now, we opened up the next pre-market session all the way down here towards 4:30 on SPY, where we closed up around 4:38 in the after hours the Friday before. So Monday morning comes and boom, we're down $8. That's a pretty big move down. That's a gap, okay? Now in this situation, let's draw in our gap. Now the gap comes in the after hour session. So I'm going to draw a gap from where we stopped trading the day prior to where we pretty much started trading the next day. This gap could be, to this candle, it could be down to here. Roughly along these lines is kind of our gap. So what I'm looking for is a fill or a move back up to fill that gap, and that's where we're going to be looking at resistance. Now, it doesn't have to happen today, but in this situation, we started seeing higher lows building throughout the morning to get rid of this box. So we're essentially looking to get back up to this price level. This line, disregard this line, this is a key line that I've had from weeks past, right? We're looking to get back up to that level, and we open up right around here. And so the way that I look at this is give it a candle or two at the open, and then we can use that as our guide, okay? So maybe it's the pre-market low, maybe it's after 5, 10, 15 minutes of the market open, you're gonna risk the low of the day, right, on this situation because we have a gap to fill to the upside. It could be the exact reverse on a gap to fill to the downside, right, where we're gonna buy puts, or we're gonna sell shares short, and we're going to pretty much play the downside gap fill. In this case, we gap down, we're looking for an upside gap fill. There's two ways to play it. you could play it both long and then you could go short. Now, going long, you're looking for that gap fill. We ended up getting that gap fill pretty much to the dollar to the cent. We got that gap fill, boom, and then guess what? That top of that gap fill, that was our resistance point. Also lines up with the high of the prior day. Boom, that was our resistance. We can play the backside of that move, and we could have shorted it right back on down to the end of the day, and then it actually bounced even higher, so you could have played it 3 times. But that was 2 solid risk-reward trades you could have taken intraday on the S&P 500 on SPY. Been in these trades for about 1 to 2 hours each, or shorter if you're looking for smaller scalp moves and you didn't hold for the entirety of the move, but obviously locking in gains along the way. Don't just let your entire position ride to the gap fill. If you're buying contracts of options, then make sure you're selling. Let's say you buy 3 contracts, sell 1, sell 2 on the way up. Leave that last one to ride in case a bigger move actually happens, but just make sure you're locking in gains along the way in case something happens and we come back down. And at least this way you're locking in gains and you're not going to take a loss. So then you look things back and you say to yourself, okay, the backside of this trade was over the other day's high. So if we closed a candlestick up over 438.50, let's say, which would be a high over the past day's trading, then boom, I'm out. But we got to make sure you don't get faked out by wicks, because these wicks and quick moves up and quick moves down could be stop loss hunts. So you got to make sure you at least wait for, let's say, a 5-minute candle close or a 1-minute candle close or a 10-minute candle, whatever your time frame you're looking at. Wait for that candle to close. If that candle closes above or below your risk level, that's where you exit the trade. And if not, you can stay in as long as the trend heads back in your direction, unless things don't start shaping your way, it's taking too long, or it's not working out according to your plan, or the day's about to end and you don't want to hold into the next day. Then exit your trade, exit your position, and move on to the next one. But this is the gap fill strategy, and it is one of my favorite strategies to look for. It happens all the time. It can happen in penny stocks, it can happen in large cap stocks, and it happens all the time across the S&P, QQQ, IWM, even UVXY, volatility products. There are plenty of tickers, plenty of stocks to pick from when it comes to this strategy. Let me know your thoughts on this strategy in the comment section down below. Happy to hear you guys like always. Make sure to leave a like. Make sure you're subscribed if you guys are new. Also, if you want more tutorial style content, there's plenty of playlists where that came from. Check out some other videos here on the channel. I got a lot where that came from. Hope to see you guys in a future video. Happy trading.